Why risk management matters more than any trading system. Here's a brutal truth. Most traders spend 90% of their time searching for the perfect trading system, but less than 10% thinking about risk management. And that's exactly why they keep failing. Because the reality is this: a great system with poor risk management will fail every time. But an average system, managed with proper risk control, can survive and even thrive. Today, I'm going to show you why risk management matters more than any trading strategy and how mastering it could be the difference between joining the 90% who fail or the 10% who succeed. Welcome back to the channel. If you've ever blown an account, if you've ever wondered why strategies that looked great on paper never seem to work in real life, or if you've ever felt like the market is always against you, this video is for you. Because here's the truth. Trading success isn't just about entries and exits. It's about survival. And survival comes down to one thing: risk management. Stick with me until the end, because I'll not only break down why risk management is more important than your system, but I'll also give you a simple framework you can apply immediately to protect your capital. Section A: why strategies alone don't save you. Let's start here. No system wins 100% of the time. Every strategy, no matter how advanced, has losing trades. I once knew a trader named Daniel. He spent thousands on courses, bought algorithms, and tested hundreds of indicators. He finally found a system with a 65% win rate. On paper, it looked amazing, but within 3 months, his account was gone. Why? Because when he lost big. His position sizes were reckless, his stop losses too wide, and his risk per trade far too high. The strategy didn't fail, his risk management failed. This is why professional traders say, risk management is the real edge. Without it, even the best strategy will collapse. Section B: what risk management actually means. Risk management isn't just about placing a stop loss. It's an entire philosophy of how you approach the market. It means limiting how much you risk on a single trade, protecting your account from catastrophic losses, ensuring you can survive long enough to let probabilities play out. Think of it like this: a casino doesn't care if one gambler wins big tonight. They manage risk across thousands of bets, and over time, they always win. Traders need to think the same way. You're not in this for one lucky trade. You're in it for consistency over hundreds of trades. Section C: the math of survival. Let's look at the math. If you risk 20% of your account per trade, it only takes 5 losing trades in a row to blow everything. But if you risk 2% per trade, you need 50 consecutive losses to wipe out your account. Now ask yourself, which scenario gives you a better chance to survive and recover? This is why professionals risk small. They know that even the best system can have losing streaks. Risk management gives them the cushion to endure those streaks without destroying their account or their confidence. Section D: real-life story of survival. Let me tell you about Emily. She started with a simple moving average crossover system. Not fancy, not revolutionary. Her win rate was just 50%. But she applied strict risk management, never risking more than 1% of her account per trade, always aiming for a 1 to 2 risk-to-reward ratio. Guess what? Even with just half her trades winning, she grew her account slowly but steadily. Why? Because her winners were bigger than her losers, and her risk management kept her in the game. Meanwhile, traders with better systems but no discipline blew up around her. Emily proved the point. Risk management beats systems. Section E: the psychological benefit. Risk management isn't just about money, it's about psychology. When you risk too much, every trade feels like life or death. Fear takes over, greed takes over, and suddenly you're making emotional decisions. That's how accounts are blown. But when you risk small, you free yourself from that emotional weight. Losses don't crush you. Wins don't inflate your ego. You're calm, consistent, and disciplined. That's why risk management is more than numbers. It's emotional armor for traders. Section F: the framework. How to apply risk management. So how do you put this into practice? Here's a simple framework you can start today. 1. Risk per trade. Limit your risk to 1 to 2% of your account per trade. 2. Risk-to-reward ratio. Only take trades where the potential reward is at least double the risk. 3. Daily/weekly loss limits. Set a maximum you're willing to lose in a day or week. Once you hit it, stop trading. 4. Diversify your trades. Don't put all your capital on one pair or one setup. Spread your risk. 5. Think long-term. Judge yourself not by one trade, but by 100 trades. Survival is success. Section G. Why most traders ignore this. Here's the irony. Most beginners ignore risk management because it feels slow. They want fast profits, quick wins, instant results. But in chasing speed, they destroy their accounts. The professionals? They know that compounding small, steady gains leads to massive results over time. Risk management might not feel exciting, but it's the difference between a gambler and a trader. So here's the truth. Strategies don't blow accounts. Traders do. And what destroys them isn't a lack of knowledge, but a lack of risk management. If you master this one skill, you can survive with almost any decent system. Ignore it, and no strategy in the world will save you. Now, let me ask you, do you want to be the trader chasing perfect systems, or the trader who survives long enough to win?